So with that, I'm going to move to our first slide here, and I should be showing my slides right now. So hopefully everybody can see this. I just want to let you know who our speakers are today. And we're very excited to have with us Adrien Cloutier. Adrien is a CFA. He's the head of equity data at Morningstar. We have Sandra Peters. Sandra is CPA, CFA, senior head of global advocacy at the CFA Institute. And we have Sirish Siddiqui, who is a partner at Bass, Berry & Sims. Our program today is going to be moderated by Campbell Pride, President and CEO of XBRL US. And before we jump in, I just also want to mention that we are offering CPE credit today. So some poll questions will come up at various points during the program. And when they do, please jump in and respond by clicking on the poll question that you choose so that we can record your answer and get your CPE credit. So with that, I'm going to turn it over to Campbell Pride and ask him to go ahead and turn on his screen.
All right. Thank you, Michelle. And we'll just kick this off, and thank you for the speakers for speaking today, and just give you an overview of what we're going to be talking about, and just give you a bit of background. So the SEC recently published their strategic goals for 2026 to 2030, and they primarily have three goals. One is to renew the regulatory policy focus to support innovation, capital formation, market efficiency, and investor protection. That's their first goal. Second goal was to shift their regulatory practices to increase stakeholder engagement, facilitate compliance efforts of market participants, and effectively return the enforcement approach to Congress's original intent. And their third goal is to operate their own internal operational efficiency in terms of organizational structure and modernizing the technology that they use. So as part of that, the Commission has begun publishing a large number actually, of rule proposals, presumably met in the goal of meeting that plan. And we're here today to talk about a number of these goals. And in addition, we're going to be talking about the publishing a lot of the proposed rules that the SEC has proposed. So in addition to publishing a statement on reforms to Reg SK, the Commission also recently published for comment proposals on registered offering reform, emerging growth company and filer status simplification, in addition to semi-annual reporting. So that's kind of what we're looking at. And so I'm going to ask Sharice first, if you can give us an overview of these proposed rules that the SEC has put out for comment.
Thanks, Campbell and Michelle. I am excited to be here. Kind of what you've alluded to, we recently have seen maybe what might be most of the significant SEC disclosure reform efforts in years under Chairman Paul Atkins' Make IPOs Great Again agenda. The central theme, I would say, running through all of these proposals, namely three major proposals that we've seen over the last month or so, really are an attempt to reduce compliance burdens, simplify disclosure requirements, facilitate capital formation, and refocus SEC reporting on what most would consider financially material information. Chairman Atkins has on more than one occasion expressed that the current rules do require disclosure of material information, and at perhaps many times also what investors may consider immaterial information. I would note that these efforts are not new. They are part of the SEC's long-running disclosure effectiveness initiative. Now, according to the SEC itself, with respect to some of the proposals that it has put out recently, it has specifically targeted executive compensation disclosure reform under Item 402, risk factor disclosures that may have become overly lengthy and repetitive, mandatory disclosure frameworks that may be viewed as overly prescriptive, and other qualitative disclosures that may no longer provide meaningful, useful decision information. The overall objective, again, is not to reduce disclosure, but to refocus disclosure. So to your point, Campbell, we'll talk about these three major rule proposals. I will focus a little bit of time on the first two and save the focus of today's session for last. So we'll talk first about the registered offering reform. The SEC has proposed expanding access to streamlined capital raising tools. In particular, under the proposed rules, we are looking at expanded Form S3 access by eliminating the $75 million public float requirement and the 12-month waiting period. We are looking at smaller exchange listed issuer companies would essentially able to utilize the expedited shelf registration statement to raise capital. So that typical overnight shelf, so to speak, that overnight offering would be available to a larger number of companies. We are also seeing a replacement of the WIXI, or the well-known seasoned issuer framework, with two new groups, the eligible listed issuer and the seasoned eligible listed issuer. Now, this would broaden the pool of companies that receive immediate registration and automatic shelf benefits. We are also seeing an expanded blue sky preemption. Essentially, we are looking at restructuring definitions under Section 18 of the Securities Act to block state level blue sky registration requirements for all SEC registered offerings. And I would say that this is particularly useful to certain industries such as the real estate investment trust, the REIT, and the business development company, the BDC space, where many issuers find themselves conducting SEC registered offerings. So they are complying with SEC requirements. And then they are also investing a significant amount of time and resources in attempting to comply with state level or blue sky registration requirements. And this would essentially eliminate that second bucket. We also see some reform on the Form S1, an attempt to modernize it through forward incorporation by reference. So you would allow that registration statement to be more dynamically updated with subsequent disclosures. So that is the registered offering reform rules. The second set of rules that we have seen come out last month would be the emerging growth company and filer status simplification rules. The SEC proposes simplifying the reporting company framework. We currently have 5 separate reporting categories for companies, and we would see those replaced with 2 large reporting buckets under these proposed rules. That would be the large accelerated filers and the non-accelerated filers. And we would also raise the public float bar required to be deemed a large accelerated filer from what is currently $700 million to $2 billion. And we would increase the seasoning window from a minimum of 12 months to 60 months. This would essentially extend the scale disclosure rules previously unique to smaller reporting companies and emerging growth companies to all non-accelerated filers. And if we are to look at a sampling based on 2024 filings, we are looking at approximately 81% of all public companies to fall into this non-accelerated filer bucket, thereby bypassing auditor attestations on internal controls over financial reporting and presenting only 2 years of financial statements and executive compensation information. So while we're talking about 81% of all public companies, this would represent less than 7% of total public market float. And this is still a significant increase from the current estimated 52% of domestic registrants in the non-accelerated filer category, which account for less than 1% of total market float. We also see a subcategory within the non-accelerated filer bucket, the small non-accelerated filer, which it would essentially be a group of companies receiving more lenient deadlines for filing periodic reports. So here we would have IPO filers automatically having non-accelerated filer status for a minimum of 5 years. So that is the emerging growth company and filer status simplification rules. I will note that foreign private issuers, or FPIs, are excluded from the reporting and registered offering relief that we've discussed. The Commission deferred changes impacting FPIs while it continues to evaluate the broader FPI framework. There was a separate concept release that came out about a year ago on that. So I will talk now about the third set of rules, which is really the focus of today's discussion, and that is the optional semi-annual reporting proposal. The semi-annual reporting proposal represents a significant departure from decades of U.S. public company reporting practice of quarterly financial reporting. The SEC's proposal would essentially amend Exchange Act Rules 13A13 and 15D13 to allow all domestic public companies to elect to file one semi-annual report and one annual report each year in place of 3 quarterly reports and one annual report each year. So under this proposal, all reporting companies, Exchange Act reporting companies, regardless of size, market cap, filer status, could elect to report on the semi-annual basis instead of a quarterly basis. If a company chooses to elect on a semi-annual basis, they would be looking at filing a Form 10K, as it currently does, as well as a semi-annual report on a new Form 10S. And this election would be voluntary. A company would make this election by selecting a box on the cover page of the 10K. And once elected, the company would be required to stick to that reporting cadence for the entire year. It could not switch back and forth. Now, the Form 10S would largely mirror current Form 10Q requirements. Companies would still provide interim financial statements prepared under U.S. generally accepted accounting principles, and those financial statements would still be reviewed by independent auditors. The primary difference, of course, is that the reporting period would cover 6 months rather than 3 months. Additionally, a semi-annual filer could elect to include quarterly financial information within its semi-annual report. And if that quarterly information is included within the financial statements, that would also be subject to independent auditor review, and of course, prepared in accordance with US GAAP. The filing deadlines for the semi-annual report would remain the same as the current 10Q deadline. So we're talking about 40 days, 45 days, depending on filer status. And companies, of course, that do not choose the semi-annual reporting cadence would then continue filing on the quarterly basis that is currently required. Now, a question obviously comes up with respect to how this reporting would impact earnings release and earnings guidance. I will say the proposal does not contemplate any general changes to the current regulatory requirements governing earnings releases and earnings guidance. A company that would elect to have semi-annual reporting done could choose to change its earnings guidance and earnings release over to a semi-annual basis, or it could decide to stick to a semi-annual basis and release earnings on a quarterly basis. And I think a company would really kind of consider between investor expectations, market expectations, capital raising considerations, as well as insider open trading windows when making that decision. Now, the SEC recognizes the existing age of financial statement requirements were built around a quarterly financial reporting system. So as a result, there would be technical amendments to Regulation SX so that the financial statements would not be considered stale for securities offering purposes. So we're looking specifically at amendments and reorganization around rules 301, 808, and 312 of Regulation SX. And the technical amendments are essential because the proposal would not function effectively without corresponding changes to the financial statement framework. I would say in conclusion, the most important point is that the semi-annual reporting proposal should not be viewed in isolation. It is part of a much broader Reg SK modernization effort. And whether companies ultimately embrace this semi-annual reporting remains to be seen. And we'll speak to the pros and cons of adopting these rules shortly. I will say, there are a lot of considerations in deciding whether or not to actually adopt this proposal for public companies. I will say the proposal, maybe we can learn some from the United Kingdom, and we'll talk about that in just a little bit. The proposal is currently open for public comment, I believe through July 6th of this year. And if adopted on the currently anticipated timeline, companies could potentially begin electing semi-annual reporting as early as 2028 by checking the box on the Form 10K for the 2027 fiscal year. Regardless of the ultimate outcome, this proposal provides a clear signal of the SEC's broader direction, a move towards a more principles-based, materiality-focused disclosure regime, and a fundamental reassessment of how much reporting is truly required of a public company. I will stop here. I think my time is up, and I think we'll kind of continue on some of the additional discussion planned around this proposal.
Doris, thank you very much. I just want to mention to all of our attendees that we do not have slides for this event. This is really just a discussion. So you will just be seeing the speakers. And I actually took that first slide down, which was just a header slide. So before we move on, I'm going to give us our first CPE questions. So let's start off with the first one. All right. So take a look at your screen. And you should see the first poll question here. Which recent SEC rule proposal would change the cadence of company reporting? Is it semi-annual reporting, registered offering reform, or emerging growth company and filer status simplification? These are the three rules that Sarah spoke about, and let us know which one covers the cadence of company reporting. Okay, we're going to take another 30 seconds or so. All right, I'm going to close down this poll. And I think most people quickly understood that it's semi-annual reporting. So thank you very much. Let's go on to our second poll. How many goals are in the SEC's fiscal year 26 to 30 strategic plan? Is it 2 goals, 5 goals, or 3 goals? All right, just another 30 seconds or so here. All right, another 10 seconds. Okay, so I'm going to close down this poll. The correct answer is 3 goals. All right. So thank you very much. I'm going to ask all of our speakers to turn on their audio and their video, and we'll turn it over to them for our conversation.
All right, thank you, Michelle. Okay, so this is a question for all three panelists. So what do you think of the broad SEC agenda with these various rules that we just talked about? And do these proposals get the SEC where it wants to be in terms of its goal plan?
You can start if you want, Campbell.
Yeah, that would be great. Thanks, Andy.
I think that the Make IPOs Great Again is a nice slogan, but I'm not really sure that these proposals achieve that because IPOs can be capital raising rather than capital formation, and capital formation is not necessarily simply selling more shares to the public. Capital formation is a broader economic definition. And there's a great speech by Commissioner Aguilar from, it's probably 10 or 11 years ago, that talks about that. In our recently released report on the semi-annual reporting proposal, we include a preface that sort of discusses this and the SEC's agenda. I'll talk about that when we talk about semi-annual reporting. But I think the real issue for us is that the commission's language is preparer and issuer focused, not investor focused. And we've seen over the last year a real degradation of investors' rights. And we like to joke that you don't get capital formation, when you take investors' rights away, particularly their rights to information. And Commissioner Aguilar's speech is quite, he goes into the need and importance of disclosure in that regard. So additionally, there's really no demonstrable proof in our proposal or in our paper on semi-annual reporting. We show that there's really no demonstrable proof that in semi-annual jurisdictions that in fact you get more listings. In fact, it's the opposite, right? And we actually went through and identified the size of the relative capital markets, with the US being sort of 10 times the size of the next largest jurisdiction. And most of the smallest jurisdictions are semi-annual reporting, not the largest differences. And Trump's tweet in 2025 highlighted that, China takes a 50 to 100 year view of the world. But unfortunately, their public companies still report quarterly. And so we highlight that in our comments and information to the SEC. I think we can talk about materiality and principles based. We wrote about that in Regulation SK, and I'll save that. But one thing I'd like to highlight is that Commissioner Atkins has talked a lot about, well, the market should decide whether quarterly reporting or semi-annual reporting is appropriate. The problem is that the SEC changed the rules for 13D and 13G related to conversations between passive and active investors and companies. And it has cooled conversations. And many large passive investors don't want to ask for specific things because they don't want to be moved from passive to active. So it's not as though the passive market or the index market can tell a company to do that sort of quarterly, to do quarterly versus semi-annual reporting. So I think those are important considerations, as well as the fact the SEC, in our view, is sort of doing this backwards. S1 and S3 determine what you do to register and sell securities. The 10K updates the S1 and S3, and the 10Q updates the 10K. We're starting with the 10Q and forgetting that it's actually SK, Regulation SK, which decides the vast majority of the contents outside of the financial statements for all of these forms. And the SEC has said, well, they're going to come out with a proposal based on that. So we don't know whether the economic analysis in any of these is correct, because if the 10K were to get slimmer, then would the cost in the economic analysis actually be accurate? And actually, if you add up the amounts in the economic analysis between the registered reporting framework reform and the semi-annual reporting, they're suggesting it would save $2.2 billion. But Chair Atkins, at a recent testimony before Congress, says the entirety of the cost of reporting, periodic reporting, is $2.8 billion. So we're going to save almost all of it. That's some of this math doesn't seem to add up. I'll stop there and let my other colleagues, but we are not convinced this is investor focused. This is not investor focused in our view.
So do any of the other speakers have anything to add to Sandy's overview?
I would echo a lot of what Sandy just said. I think the word that comes to my mind when I see this, particularly semi-annual reporting, which I know we're going to get into, cautious. The idea of creating less barriers to public market entry, cost efficiencies, more focused disclosures, and a long-term focus, that's all great and admirable objectives. It's about how it gets executed that I really worry about. How do we ensure, if all this goes through, the proper flow of information to investors, particularly around material disclosures? So as the time lengthens between these reports, what becomes material information that needs to be disclosed? How is that being enforced? How are we getting that in the hands of investors quickly? That is a large concern of mine. We haven't really seen a lot of that in enforcement in recent times, and so now you're going to have longer times of companies sitting on that material information. Also, the idea that one size fits all also is a bit concerning. So are there certain industries or certain types of structures where we still do need quarterly reporting, as opposed to just saying everybody doesn't need to do it? And then also, the disclosures that will come out with the new, as Sandy was talking about, what does that new 10S look like? What is the information that's going to be provided in that? Will that get slimmed down? So is it a bit of a double whammy that you both lost the 10Q, and then we're going to have trimmed up 10Ss? Those things make me quite cautious about this. Great objective overall goals. How do you execute upon that? That's the worry.
I would agree with my fellow panelists. I would just add, we still have the 8K out there, the 8K requirements that would come up with respect to material events as well.
Yeah, well, let's talk about that 8K maybe when we get to semi-annual report, or when we get more specifically to semi-annual reporting. But having been a preparer myself, I know there's a lot of debate about what becomes in an 8K. And there's definitely a desire to get good information out there sooner than bad information, right? And so, our survey that I'll talk about actually asks questions right about that very topic.
So perhaps we can move to the next question, which is the SEC changes are aiming to make IPOs great again, as you mentioned, Sandy. But do these rules get us there? Why? And let's talk about why the IPO market has slowed. This has been one of the concerns of the Commission, and why has things like the private equity market been so strong?
I think when we wrote our letter on SK, so the SEC has publicly asked for a roundtable on executive compensation about this time last year, and they asked for comments. And then Chair Atkins in January asked for comments on what to do to change Regulation SK. And we said, look, these standards are already principles based, as an example. The risk factors are the largest disclosures, and the disclosure requirement is 236 words long, and it gets you 30 pages of disclosures. So you probably need more rules to get slimmer disclosures on this. So going to principles, I don't know how much more principled they can get on the risk disclosures. To get to 200 words, I'm not really sure what they think how they're actually going to get there. But I think fundamentally the premise that reducing information in the era of AI is going to get more capital formation. I wrote an article for CFO.com a few months ago before these proposals came out that asked if the SEC is regulating for a pre-AI era. The proposals don't really talk about technology and the way technology would be implemented to make things more efficient. They also really haven't done an analysis of actually the extent of disclosures. If you look at our comment letter, we picked the Magnificent Seven. We looked at how many pages were in each section. And we looked and said, this 100-page 10K for Apple, when half of it is the financial statements, doesn't seem like a lot of information, right? So are you really going to get more IPOs? But we also step back and we say in that same letter, we think the SEC needs a blue ribbon commission to look at private versus public markets and really identify what are the issues at hand, right? Because the SEC, simultaneously with making IPOs great again, is dealing with an executive order from the president, which says, well, we'd like you to give defined contribution plans access to private markets. So if you take a private company, put it in a private fund, put it in a 401k, they've gotten access to the biggest capital markets in the US, the biggest pool of money, and they're still a private company. So the SEC is actually cannibalizing their own desire to make IPOs great again by allowing that to happen. And there's a whole series of conversations with respect to making the transparency that's needed for private markets. But we see this proposal as making public markets more opaque to compete with private markets rather than making private markets more transparent to compete with public markets.
Yeah, I would say that I think specifically, is it going to make IPOs great again? It's a step in the right direction, but certainly not going to get there on its own. Why are private companies staying private longer. We Morningstar, we also, as part of one of our big divisions, PitchBook, which monitors private markets intensely. From what we've seen from the analysis, first of all, the growth of the availability of capital in the private markets is one of the reasons that you're not seeing as many IPOs. People don't need before. Yes, you needed to get to, I need equity, I need debt, I need to get into the public markets to get that. There's a wealth of now that capital available to them by staying private. The valuation levels also we're seeing in the private markets are quite high, much higher than they would get in the public markets. So if they actually went out there and said, hey, want to come out with my IPO, they're probably going to have to take some down rounds from where they used to be when they last raised capital. And we're seeing that when companies are coming up now for rounds, they're seeing that downward trend. So why would I go out there and do that? Third, the focus a lot of the times in the private markets is about growth, top line growth. And so just get out there, cash burn, not as much of a concern. We just want to see that growth story. How do you build out your new product? When you get into the public markets, yes, there's going to be more scrutiny on your profitability. And you see it with some of the, obviously the big IPOs coming out there. Great, amazing, huge potential. But then, oh, look at that cash burn. Okay, when are they going to become profitable? All of a sudden, the second they're in the public eye, whereas in the private markets, they could have a little bit more focus on that long-term growth. So well, it's great, and certainly some of them might go, okay, well, there's a little less regulation or a disclosure that I need to go out into the public markets. It's not the really big motivators for them going over into those markets right now.
We would just like to have that conversation a little bit more publicly with some consensus around that, so we can use that information to sort of dispel any narratives that may exist. So
Mhm.
it's that transparency that comes from people doing analysis, getting information and doing analysis
Yes.
that enhances that price discovery. So it
Just like you said, information is that's the cornerstone of every market, right? And an efficient market for sure. And so any restriction of that's never going to be good.
Yeah, that's why we put in our report that I'll talk about. That's why we included the preface, because we needed to remind people what we fought for here, right?
Yeah.
And why we did that back to 1929.
All right. Well, thank you for that. And it's like, let's just move on to let's focus on the rule proposal for semi-annual reporting. So let's go through some of these. Like, what's the potential impact of giving companies the flexibility to opt for semi-annual reporting? What do you see is going to happen as a result of that?
I can start on this one. I'll put on my hat as a data provider first. So that's where I come from, equity data. One of the things that challenges we're going to see is as companies are now, okay, let's get into 8Ks. A company's going to have a material information that they disclose. My worry is the level of information they'll provide into that. And so let's say, example, my plant has been hit by a hurricane. I'm going to miss $10 million on revenue, or this is what I think the potential impact will be. As an equity data provider, I have many metrics beyond revenue. What's the PE of that firm at that company at that point? I don't know. They didn't say necessarily what the bottom line impact is going to be. Do I change it? I'm not in the business of, and we do have a division, which will be equity research, can take a look and opine on that. But I'm equity data. I'm supposed to provide that. So I'm not going to change my number because it wasn't provided. All right, but the market knows that that's a change. And I worry also because individual investors who might be using our data through various parties, such as like our free website on or something like even like a Yahoo Finance, they're not going to have access to that. Whereas somebody who's paying for institution, who's paying for research, well, they're going to opine on how that happens. So that worries me, that asynchronicity. And then also comparing quarterly companies to public, or sorry, to semis. So some will still report either because they're in another regime or they volunteer to do quarterly, and someone's reporting annually. How our data then lines up in our systems to make sure that like, hey, am I comparing apples to oranges or am I actually apples to apples? That's going to be a challenge, and people are really going to have to watch out for that. Before it was like, okay, reporting season's over. I can take a look at all the companies. They're all kind of aligned up. Many companies are in December end. I can take a look. Now it's going to be, oh, wait, that company's looking like they're doing really good when the rest of their industry went down. It's like, no, they just haven't reported yet. And then now I'm going to start speculating on what potentially could have been there. Those are the concerns I think from a data provider hat on that I have with this.
So I'll go next if that's okay.
Yeah.
I would everything that you said. I think that as a part of our work on this, we knew this proposal was going to come, right, based on the tweet last fall and Trump's ask for the SEC. So we did a survey of our membership back in January. We had done a survey back in 2019 when he tweeted in late 2018, and we asked a series of questions. Our investor members told us they did not support a move to semi-annual reporting. So we decided to redo the survey. We had put the survey into production, and we're like, when all of these individual, I guess we're up to about 37,000 individual investor comment letters that have come into the SEC. But as we saw the Reddit post and the keepitquarterly.org, we decided we were going to issue our survey and some stuff around it to contextualize sort of our history and framing the debate of quarterly versus semi-annual reporting and what our survey told us relative to the debate. We decided to put it out early. So we issued that on the 10th or 11th of June. It's available on our website, and it's investor perspectives on quarterly reporting, why investors support it. Forget exactly the title. Why investors support it. What investors tell us about quarterly reporting, why it matters, and why they support it in an era of artificial intelligence. And we went through the survey and we asked 46 questions, which one of my colleagues was like, this is way too long. Nobody's going to respond to this. And I'm like, they can drop out whenever they want to drop out. But we had a 5% response rate. So we sent it to 48,000 people and we got 2,600 respondents. So many respondents that our market intelligence people is like, you don't need to send a second reminder. It's statistically significant. And about 3.5% held on to the last question. And we asked questions about the frequency, the form of semi-annual reporting. In fact, we asked if they wanted a 10S before we knew there would be a 10S. And we asked about the flexibility, including in this proposal. Most people are really surprised when they hear that a company can elect semi-annual this year and quarterly next. Not necessarily that they're going to do it, but that they can, right? Investors cringe when they hear that, right? Ew, really? And we ask about earnings releases versus quarterly reports, because in 2019, that was the focus of the request for information then. We ask about voluntary quarterly reporting. We ask how many companies do you think will continue will continue to do quarterly reporting? And we ask about 13 or 14 implications of quarterly reporting, includes the asymmetry of information, which you just spoke of. And we ask about things that people aren't thinking about. In many semi-annual jurisdictions, companies pay dividends semi-annually. In this country, we're used to dividends being paid quarterly. Will companies change their dividend payment? Because that'll change discount rate, and that'll change who owns them if they're depending upon if they want them for income, right? These are real economic consequences. Bid-ask spread, volatility, the cost of capital, a series of questions about that. I can't go through them all here. We also ask about long-termism, because I personally am sort of sick of the long-termism comment, because 6 months is not long-term, right? And moving 90 days doesn't change it to being long-term. So we ask, what do you mean by long-term? Is it holding period? Is it capital infusion? Is it how long is it? We ask them if moving would change their view from 90 to 180, and they're like, not really. And then we ask them for to go for a year. If you really want long-termism, let's just go for a year. They're like, no way, right? And so we wanted to sort of push it to its limits. But we did the survey. It's on our website. It's on my LinkedIn if anybody wants to look at it. But one thing that was absolutely, to your point about flexibility, they dislike flexibility more than they disliked semi-annual reporting. 80 to 85% of the people were like, no, you can't change and you can't choose your own, right? Because we ask, our questions were sort of chef's kiss in how we asked them relative to what we thought might come out, and what actually came out. And the answer was no on flexibility, right? For the very reasons that you spoke about. Because one thing the SEC semi-annual proposal doesn't do is it says, well, you're going to lose 310Qs, and the gross number doesn't add in the cost of doing the 10S. They do another net number on that, and there's absolutely no consideration of the cost to investors of this change. Changing models, changing conversations, no quantification of that cost at all in this proposal. Things are mentioned, but they're not actually quantified. So the economic benefit, the overall economic benefit, in our view, hasn't really been considered. So it was a hard no. It was a no. It was a no on semi-annual, and it was a hard no on flexibility.
I agree with my fellow panelists here, very much so. I would just add, even from, obviously the investor perspective is critical here, and we've heard about obviously the kind of the problems and the nuances involved for analyst coverage. And I would say from a company perspective, just from the kind of the legal technicalities that would attach here, many public companies have debt covenant compliance requirements for quarterly financial reporting. And so, just kind of choosing to switch over to a semi-annual reporting basis may run up against even some of their own debt covenants that they've undertaken. And of course, we have insider trading restriction considerations and capital market raising concerns that would attach from, from a 6-month sitting on information for 6 months versus a quarterly basis.
You know what really came up in our survey that it surprised me, but it really shouldn't, when I went back and looked at the history, because we have a book called From Practice to Profession that we wrote in 1999 that shows the history of what was then AIMR, it's now CFA Institute, and talks about our history being rooted in the Securities Acts. And it starts, the first 2 chapters are about information. And it talks about insider trading and the asymmetry of information. So investors feel the same way about it today that they did in 1929. And they're very worried about insider trading in the sense of insider trading and asymmetry. They're worried, as are we, that the 8K will be just enough to keep the window, the insider window open, but not enough for you to determine what the income statement impact is of that event that you described, right? So we told you, right? So the other thing in our survey proposal is that investors said that if you go to semi-annual, they want voluntary reporting. They don't expect many people to do it. And that if they do it, they want a 10Q. They don't want a press release because they want the structured information that they would get, and they want the legal liability that comes with it, because 8Ks are filed, they're not furnished. And with the 10Q, you have the management certifications, right? So we put in a table that explains sort of the legal distinctions between the two, and investors voted for the 10Q of the press release, because investors think that the press release and this 10K are complements, they are not substitutes, right? In the press release, they want management. I mean, I was surprised when I came here after having been a preparer, how much investors size up management and have a view on their behavior and their aggressiveness from press releases versus what shows up in the 10Q. I was really surprised at how intuitive they were, even about the company that I was the controller of. Like, we weren't fooling anybody, right? They got the behavior, right? They're looking for management to size up management and assess management's behavior. So I would encourage people to look at the press, or at our report, because it has a thorough list of all the questions. But we also filed a comment letter with the SEC, and in that comment letter, we ask them to defer the due dates and to consider the order of which these things need to be done and the interconnectedness of the economic analysis of these. Because how do you change all of these without knowing what you're going to do with SK, right? And that was Hester Peirce's she made a comment about this at the very beginning, when they released the semi, or when they released it, and then she made something even more current. Or when they released the second proposal, I forget, but she seems to be, oh no, it was at the SEC Investor Advisory Committee. She seemed to acknowledge the large number of individual investor form letters that they have received, and the balance between slimming down the 10Q versus getting rid of quarterly reporting. And that has real impact to the economic analysis of this equation. So there is, well, I don't know if we want to go on. I have one more thing to talk about on the reporting framework proposal when we're done talking about semi-annual reporting.
Yeah, well, let's deal with that, and then we've got a few questions come in from the audience, and then we can start on those. So if you want to talk about that last thing, Sandy.
Oh, I'm sorry. I thought you were saying after that. Okay. So, Suresh mentioned the two other proposals, the one that would change the requirements for S1 and S3. It's the registered offering reform document. And then the one with a really long name about emerging growth companies and filer status we just call it the reporting framework. I think not enough attention is being paid to that proposal, because it sort of alludes to the fact that, oh, we're going to help small companies go public. That is not the case. This is about giving accommodations to even large companies who enter the marketplace. And it is about taking even large accelerated filers and making them to have the same disclosures as emerging growth companies, right? And we're actually working on a shift chart that better explains how that's happening. Because if you think of SpaceX and OpenAI and Anthropic, even if they're large accelerated filers, they're not going to have to do, I mean, it drives me crazy when I hear people say, well, Elon Musk is a trillionaire. And I'm like, I say to myself, he's a trillionaire that doesn't have to do internal controls over financial reporting. Or if this proposal passes, and he won't have to make the executive compensation disclosures of a large accelerated filer. So I don't think people are really focused in on that like they should be. And I think that we have to draw more attention to what that sort of long title document is actually doing, because that's actually going to eliminate executive compensation disclosures for 80% of the public companies, or not eliminate them, substantially reduce them, right? And the one thing I'm always surprised by is how much investors care about executive compensation, right? And how focused they are on it. It shouldn't be, but I'm always interested in that. So I want to draw people's attention to that and to some of the summaries that are out there. And we'll be putting out a chart that shows the shift, because you really need to understand these rules to understand what the consequence of the rules are. Because the SEC doesn't really tell you that. You sort of have to analyze and intuit that.
All right, thanks for that. All right, so then just another question, just on terms of just looking at, and you briefly mentioned this, Sandy, in your previous remarks, is what can we learn from non-US markets, and is there anything there that we should be paying more attention to than what you mentioned earlier?
For us, we think that comparisons to the UK and the EU and other jurisdictions these are much, much, much smaller markets, right? Much smaller markets. You don't see that their number of IPOs have gone up when they're going to semi-annual reporting. And in 2016 or 17, CFA Institute's Research Foundation, before this was sort of tweeted about in 2018, did a study to look at the UK market and to say, is there more capital investment in companies that move to long-term? And the answer was no. And a lot of people continue to do quarterly reporting, but then what the SEC proposal doesn't consider, and they say in the proposal only 20% of companies will go to semi-annual reporting. Even our members, we thought it was low, only I think it's going to be 32%. They don't seem to recognize that in those jurisdictions, that number that went to semi-annual without voluntary quarterly reporting got larger over time. So there's to our mind, and in our comment letter to the SEC, we're like, you have a lot more economic analysis to do in our view, because this is the world's largest capital markets. And the one thing our survey was, I should say, is our survey was global. And we wanted it to be global because for two reasons. We wanted to know about global investors who invest in the US, and we wanted to know about our members who sat in other jurisdictions, in semi-annual jurisdictions, what they thought. And of the 46 questions, only 11 had differences that we were significant for us to put a regional disclosure in, and none of them were different. They were just maybe 10% more of the total different. So investors globally are pretty uniform on their view in the desire for quarterly information.
So, Adrian, do you have anything to add to that?
Actually, that was quite well put. I totally agree with what Sandy said.
All right, Girish?
I would also say, oh, I'm sorry.
I was just going to say I agree.
Sorry, Sandy.
In our report, we got 1,000 comments from our members, 700 on the first series of 7 or 8 questions, right? And we included all the questions in an appendix, or I'm sorry, all the comments in an appendix to our report. And we didn't include all those pages. It's a link that you can access, but I would encourage anyone to read those comments because they're better said than we could ever say, right? There's maybe 1 or 2 people made a lot of comments about Australia and how they didn't like to be a non-Australian investing in Australia because they have semi-annual reporting and because there's information available in the local community and on the street of the people there that doesn't make it if you're not actually in that community. So there is an asymmetry of information that they believe exists in jurisdictions such as Australia.
Right. Okay, so we've had some questions from the audience, so maybe we can go through some of those. And maybe, Suresh, this is something for you. And you'd mentioned this with debt covenants. Has the SEC, and maybe you could talk about the Sandy as well, is there any implication for things like derivative markets, which may have derivatives based on quarterly reporting? And has that been covered at all? Anyone heard anything on that? So if that hasn't, then we go to the next question. All right. We've got another question here. An attorney I work with suggested that lawsuits might be filed to delay these rule implementations. Do you think that's likely?
I do. I've heard the same thing.
Okay.
We don't know who's behind keepitquarterly.org.
Okay. The next question we have is, do each of you have any alternative approaches that you think for these 3 SEC goals that the SEC should be doing to improve capital formation?
I like streamlining. I know I don't want to abandon the idea completely of making it easier or less onerous on preparers to get the right information out there. And a lot of these reports, and certainly are long, and I definitely, my local, our CEO and I were talking about it actually just yesterday, the amount of work and effort that goes into it. So are there ways to evaluate trying to make the 10Qs as they exist, or even, if it was to be the 10Ss, more streamlined, provide more of the information that investors are looking for without some of the, very onerous keep going that parts of the reports that maybe not as many people are using. I know that's a little bit vague, but having some discussions around that, getting into there, what are investors, do they find useful? What don't they find useful? Why is that? I think Sandy kind of goes back to, you were saying like, it's all about the investors in the end, right? And so what do they need more of, and getting and talking to them, and then conversely, what do they need less of? And then maybe finding a better strike that way, as opposed to just saying, well, less reports is the way to make it easier on preparers. So
Yeah, I
Right.
agree. I think that kind of focus or kind of method of allowing a company to focus on quality data out to the markets versus uh, maybe extraneous hurdles or burdens. I think the blue sky preemption is a great thing if for an SEC registered offering, for example. Just because a company thinks many times over when conducting that, just given all the steps involved and the investment just for legal compliance.
Okay. All right, we have one time. We've got 3 minutes. We've got time for one last question. It's a long question, but I think it's a simple answer. Do we have any information on how many issuers rather than investors are in favor of semi-annual reports? Seems like a pretty pure downside on the investor side, but I'd be curious what the issuers think. Do issuers themselves actually think that there are going to be cost savings? And if so, is there any information that the attendees or the speakers are aware of the saving, if there are actually any true savings for issuers, and what is the upside for issuers?
I again can speak just because I was talking to the CEO and CFO about it, and yes, they do feel that there will be tangible benefits that come out of it. Yes, it's not like all of a sudden they still have to report. So it's not like all of a sudden there's going to be a huge headcount efficiency savings by dropping people, but the amount of time and effort that goes in and how many meetings that have to happen each quarter just to get everything aligned. They put a lot of seriousness into it, as they should. Is that the right short-term focus that they can, that they should be doing with the company, and that they could reinvest that time into doing some more of like an opportunity cost and more focusing on the business? To being have to report, one of our big mantras at Morningstar is about long-term investing. It's like the pinnacle, or sorry, the cornerstone of what we do with our equity research: invest for the long term, Modi business, that sort of thing. And so they're saying, well, I'd like less to report on that. We actually don't even do quarterly reports. It's from our founder. Sorry, do quarterly reports, obviously, but we don't do quarterly conference calls. Again, for the same reasons, we think it's too short-term focused. And so there is real cost in there. I think it's just about weighing those costs. And we had a good debate about those costs and what we're seeing and how does that deter, again, getting back to that whole make IPOs great again versus the benefits that investors get from it. So it's going to be a trade-off.
Right. Thank
I
you.
agree. I would just add, I think also industry matters a lot for some issuers in deciding whether or not to opt for this.
Right.
Yeah, can I, I mean, I've been a preparer. So certainly there would be, benefits of not doing the 10Q or, going to disclosure committees and those sorts of things. But the reality of it is that, I mean, I was the controller of a large insurance company. We were doing monthly closes, right? I mean, certainly we didn't rebook all the reserves every month. But still, that's going to happen. No business is going to say, well, I'm not going to look at everything until, the SEC tells me to look at something, right? By preparing a set of financial statements. So I think it depends. But for us, the problem is that there's been no consideration to what the consequences of this is to investors, right? Investors pay for all of this, right? Ultimately, investors pay the price for all of the costs of the reporting, and they told us they're willing to pay the cost, right? So I guess we will wait and see.
Right. Well, and on that, that's a good note to end. And I'd like to thank all our panelists for today. It's a very good discussion, and I'll hand it back to Michelle to wrap it up.
Great. Thank you so much. Yeah, we have some quick poll questions to do. So our next poll is on, okay, semi-annual reporting requirements. Okay, so the SEC rule for semi-annual reporting would maintain quarterly reporting, but give companies the option to report semi-annually, or require all companies to report semi-annually, or require all companies to report semi-annually, but give them the option to report quarterly. Which one is accurate? I've got another 30 seconds here. And I also want to mention that we will be posting the replay from the call today, for those of you who may have missed some. All right, I'm going to end the poll on this one, and we'll go to our last poll, which is the SEC semi-annual reporting proposal would create a new form, which is called Form 10 Semi, or Form 10S, Form 10Q, or Form 10K, which is the SEC semi-annual reporting new form. All right, just another 30 seconds here. And I'm sorry, we've run over a couple minutes. All right, we're going to close this poll down. And thank you all so much for joining us today. And thank you so much, Sandy and Adrian and Sirish and Campbell. You guys did a great job. This is really interesting. It's a very hot topic, and I'm sure we'll have more to discuss on this in future. So thanks again.
Thanks for having us.
Thanks.
Thank you.
Very well.
Bye.